Hey everybody, welcome to this free edition of our Trader Use Group Weekly Roundup for the trading week ending March 22nd, 2024. I'm Preston Brent. Thanks for tuning in. Well, this week's theme is the Fed spoke and there are no worries. That's kind of what I'm hearing here. Let's take a look at how this week fared. I would say it's been a very interesting few weeks leading up to the Fed meeting. But as you can see on the screen here, everybody had a really solid week. Everybody's in the green. The momentum continues. Year to date, everybody's solid. Where we close for the week, you can see that the S&P is still leading the Nasdaq just a little bit, just slightly under 10%. Russell is showing some signs of life, a little over 2% year to date. I mean, we really should give thanks to all the central banks, not only the U.S. Fed, but the Bank of England, the ECB, Bank of Japan. They're all talking about cutting rates. With the exception of Bank of Japan, they raised it but just 10 basis points to come out of a negative rate situation. But they're still putting stimulus in the economy. We're also seeing major Latin American central banks too, led by Brazil and Mexico. They're well on their way to rate cuts also. So we're seeing this market theme of the Feds and most central banks are just hell bent on talking about cutting rates. I don't see any of them talking about raising rates, with the exception of the Bank of Japan. And even then, they've got a lot of stimulus going into the economy. And with inflation still running a little bit rich, the markets have just bid off that, we're going to have a very accommodative Fed. So not only that, but the Fed's talked about slowing down their quantitative tightening. So that's just putting more juice into the markets. Okay. Now, one of the drivers this past week was, when we got the Fed meeting, they basically kept their rate cuts this year to 3. There was a lot of speculation they would cut it to 2 or possibly even 1 when inflation came in hotter in January and February. But never fear, they want these markets strong. It's a presidential election year. So they basically said we're still on track for 3 rate cuts, and even suggesting that the increase in inflation in January and February is just a speed bump, and we're going to see it coming down. So they did, however, raise the higher rate for 25 and 26, right? They say 25, the rate should be slightly under 4%, and then by 26, slightly north of 3%. So they basically raised the rates about 25 basis points going out in time. Okay. And he's Boom Boom Powell is not really overly concerned with this uptick in inflation. So the markets all chalk this up to just really great news. You can see the forward PE ratio is 21.58. The trailing is 23.47. So they have cut the earnings projections, or they've cut the PE ratio by just slightly under 9%. On a go forward basis, the dividend yield 1.35, 10-year treasury 4.22. That's where we closed. Earnings yield is still a healthy 4.64%, but it's not much higher than the 10-year yield. Remember, you can get a 10-year at 4.22, supposedly risk free, or just get another 60 basis points or so, and then you can play into the equity market. So there's not a lot of risk premium there. It's fairly tight, so that'll still keep, I think, the 10-year Treasury and the U.S. Treasury market fairly popular here. Current VIX fell down during the week, came down about 9, almost just slightly under 10% to close out the week at 13.06. You can see the best performer for the week was communication services. The worst was real estate, obviously, because, same thing year to date. Real estate down 2.94%. Because rates are going to stay a little bit higher for longer. Communication services leading the way, not only weekly, but year to date as well. Okay. And of course, if we go across the pond and see what's going on over in Europe, you can see here in Europe, everybody but the CAC 40 for the week was in the green. Year to date, still very healthy. The Euro stocks, which are the 50 largest companies across Europe, a very healthy 11.25%. Okay. Great Britain, by the way, they're back into the green, both weekly and year to date. The BOA, Bank of England, they kept their rates unchanged at 5.25. That's the fifth consecutive meeting where they haven't touched anything. Although the vote now is favoring that they're getting a little bit more dovish, like the Feds, right? So we got that data coming out. The CPI in Great Britain decelerated to 3.4% in February. That was from 4% in January. And their services eased about 6.1%. So we're seeing Great Britain kind of consolidate. Same thing with the Eurozone. I mean, if you look at it, the PMI showed that the output of goods and services came in to pretty much stabilizing in March. All right, just a marginal decline. The composite PMI rose for a ninth month to 49.9 from 49.2 in February. So keep in mind that they're still below 50, which shows contraction. So all of Europe, including the UK, is coming out of probably, certainly the UK, out of a recession or just really having a hard go of it, right? But I think they're coming out a little bit better. And so the risk of a bigger move across Europe is upside risk. Okay. And then, of course, if we go over the Asian markets, you can see here, let's talk about the Nikkei. Look at that, 5.65% for the week, 22.21% for the year. Very, very strong. They finally did it, Bank of Japan. They finally shifted out of a negative interest rate policy. Now, they only raised it by 10 basis points. They also ended their yield curve control program. However, the Bank of Japan governor, Ueda, he affirmed that they're going to keep a very accommodative policy. So you throw in both of those two, and it was just extremely bullish for the Japanese market. All right. On the economic front, the CPI jumped up to 2.8%, which is what they want. They want higher interest or higher inflation over in Japan. That was a big sharp jack up from January's 2%. So over in Japan, they just kind of had a Goldilocks scenario for the week, and it just jacked a lot higher, as you can see. And then, of course, if we go over to China, China and Hang Seng were in the red, both for the week. China is just barely in the green year to date. Hang Seng is about the same, but in the red. Chinese equities, they're having trouble still with their property sector. Okay. Property investment in China fell by about 9% in the January-February period. Now, it slowed to a 24% drop in December, while property sales sank about 20.5% in the first 2 months of this year, right? And that's after slumping 23% in December. So we're getting property is still a major drag on the Chinese equity markets. We did get some pickup in industrial production. It came in above forecast at 7% in a January-February period, right? And that was up from December's 6.8. Fixed asset investment also grew 4.2%. Retail sales rose more than expected over the 2-month period as well. And their unemployment rate is at 5.3%, while their youth jobless rate edged up to 15.3. Net over in China, they're still being affected by the real estate market. Very, very putting a ton of drag on the markets over in the Asia. So what I want to do, let's just shift over. I'm going to show you a couple different screens. First thing I'm going to do is I'm going to show you the SPX on a weekly chart. We're going to step it out just a bit here. So let me just get this up here. It's going to take about 10 seconds to come up on your screen. But what you're going to see is a weekly chart of the cash index, the SPX. And what I've got on here is it's called an Andrews pitchfork, and it's really good for measuring long-term trends. Good on a weekly chart. And you can see what I used as major pivots was the December low on 2018. And then I used over here the COVID low on March 23rd, 2020. So those were the major pivots, and then off the high pivot right before COVID. And you can see how the price actions marched right up. Anytime we get too far north of this upsloping channel here created by this Andrews pitchfork, it tends to come back towards the channel. The other thing I have on here is extensions off these highs that were made back in January 2022, and this was the 2022 year where everything came down and we had a bear market. So I picked the highs there, and then I picked the low, bear market low, sittered right around October of 2022 before we started this big run up here, okay, into 2023. And you can see here on these extensions where I've got these key Fibonacci extensions. Whenever you get into dry powder, meaning you're in areas where the market's never traversed before, these Fibonacci extensions and GAN and some of these other technical tools really do a good job of giving you an idea where you can expect resistance, right? It's based on human nature, based on where people tend to take profits. You can see this 1, 2, and then this is an ABC, and then an Elliott wave 3 here. And we hit my initial target here, was sitting right around 5,200. We've blown through it. And remember what I projected for the end of this year. I said we're probably going to be between 52, 53.50 to finish out this year. And, you know, we closed out this week right here at 52.34, right? And we're close. I do believe that if this momentum continues, we could possibly even see 5,500 this year. But folks, not without a pullback. You can see my system is calculating a possible pullback near where we were and the highs that were made in January 2022, call it 48.50 area, okay? Now, if I put it on a daily chart, we'll zoom in just a little bit, and let's get the daily chart up here for the SPX. You're going to see here that we gapped up right here, and it's been a strong week. I do see a little bit of a near-term pullback in the SPX and the S&P, all right? You can see these projections through the end of the year, 53.50 up to 5,500. Somewhere south of 5,500, I don't believe we'll get much further than that. You can see the MACD is just sliding down. This pattern in the MACD is more of a consolidation pattern, even though we've been moving up. This pattern has existed for almost all of this year, right? Just nowhere to go. And that would reflect also the lack of breadth in the market, although I'm starting to see some participation with more stocks, but it's not where we would like it to be, where I would like it to be, right? So a natural pullback point would be the upper boundary of this Andrews pitchfork, which puts us right around 49.50 to 5,000, back in this area right here. Really, this hit at time and price perfectly right in the middle, because these black bars give me a timing, and then the location of the bar gives me a price, because you got to remember there's still price and time associated with all movement in the market. Where is the price, and then how long does it take to get there? So I do see a higher probability of a little bit of a risk going out to April and May timeframe of a pullback, okay? So that's a little bit about what I'm seeing here on the upside. Now, if we look at the downside and just how far back, as I said, around 5,000, all the way down to about the 49, 48, 49 area, right? And if I shift the screen a little bit and just give you more of a near term, we're going to look at the same chart. But what I'm going to do is I'm going to shift to another chart using a couple of different indicators here. And what you're going to see, again, it's going to take about 10 seconds to come up on the screen, is the SPX daily chart. And you're going to see here this trend line, right? This trend line on the SPX, we've been following it very closely. In fact, the 50 EMA has been running north of or south of the trend line, but following it. And the same thing with the 200 EMA, right? And you could see the potential pullback points with Elliott wave, which puts us right around 49.87. So let's call it 5,000. You can see these pullback points that I'm letting the system calculate, the midpoint, somewhere between 50.66 and 49.50. All right, and that would be the risk I see going out to the March time frame. Okay, so these are just some of the things that I'm seeing in the market here. And then, of course, if we come over and look at some of the other major indexes, all right, and let's just shift over to Nasdaq 100 futures. Let's just get you on the screen right here. That'll take about another 10 seconds to come up. And on the Nasdaq 100 futures, you're going to see the same trend line, almost looks like the same chart. Okay, and you can see this trend line pointing up. It's honored the trend line. Every time we've gone slightly below it, the very next bar is back up above. You could see intraday moves below, but it never closed below. The only time we closed just slightly below was on the 15th of March, but then the very next day it's moved back up. We did not make new highs this past week. The last new high in the Nasdaq 100 was on March 8th. All right. You can see the MACD just going lower and lower as we've been going higher, but a very consolidated, choppy MACD, right? You can see that our last high was on March 8th, up 9.9% for the NASDAQ 100. Now, if we look at the composite index, which includes everybody in NASDAQ, look at this. We made a new high. We made it actually on March 21st. We're up 10.18%. So the fact that the composite index is higher than the NASDAQ 100 futures tells me that we're getting some participation across a lot of other stocks in addition to the Magnificent Seven, right? And if we look at the equal weight SPX, let me just find this on the screen here. Let's see here. Here we go right here. Here's the equal weight. The equal weight, you can see here, actually made a new high on the 21st, up 6.6%. Okay, so we're up here looking strong on the equal weight, which is what I like to see, right? And of course, if we just look at the SPX, you can see here the SPX. It was down a little bit on Friday, but we finished up just like the cash index, as I said, we're up about 10.3%. That was an intraday high, right? And this is kind of where we're sitting here on this thing. So, and then one final, and I'll show you guys with the Dow. Dow had a down day on Friday, but you could see it made new all-time highs. Whoops, let's get this right here like this. It made new all-time highs on the 21st, up 6.18%. You could see the trend line. A pullback to the trend line to me would make sense, Dow futures. Okay, and then the Russell, if we look at the Russell, you can see here, it's up as well, but the last all-time high on the Russell was on the 8th. It was only up 4.94. So small cap is really not participating in the rally. You could see the upslope and trend line with the 50 EMA just kind of running neck and neck with the trend line. Okay. Now, of course, if we come down here and look at the VIX is settling in a little bit. It was up just a little bit on Friday, but this is the trend line. The VIX has been moving up really since the middle of this past December and moving up. We finally broke it here, right? Once we got through the Feds and everybody can breathe a sigh of relief, the VIX came down, but I suspect it's going to find its way back up when we have, like I said, the period of risk is from April to May. So once we get through Q1, and when I say April to May, remember what we got coming up in April. There is no Fed meeting. Well, they meet the last day of April, and the official Fed meeting is May 1st. But we're going to start getting earnings in, and this is going to be a crucial earnings period where the bar is a little bit higher, and we're going to see where all these AI stocks plus all these other companies are faring. And this is where I think we have a risk of a little bit of a pullback, anywhere from 4 to 8%. Let's call it 5 to, under 10%. I don't see much more than that right now, unless we get a surprise in the data. Okay. And then, of course, if we look at the treasuries, if we look at the 10-year interest rate, it was down a little bit on Friday, right? But you could see here it came right up and tested the high for 2024. But it's sitting here near highs, right? Sitting actually on the 200 EMA and the 50 EMA. They're kind of going back and forth with each other. We got a little bit of a divergence here, even though it didn't make new highs. Close enough that would suggest the rates could come down just a little bit, okay? And then, of course, if we come down here and look at the bond market, naturally it's the opposite of interest rates. it's off the lows here for 2024. Remember, the higher bonds go, the lower interest rates go. Okay. And then, of course, if we look at the U.S. dollar, dollar had a strong day on Friday, moving up. The U.S. economy is still, the strongest economy out there right now, really, and that's putting strength in the dollar, right? Longer term, I want to be long the euro, although you could see here the euro came crashing back down below, so we got to watch this very closely. And in the yen, as I said, they raised their interest rates out of negative, but you could see the yen kind of peel back a little bit. Members, I'll go through ways to trade the yen in our weekly market watch this Sunday evening at 7 p.m. Then, of course, if we look at a couple of key precious metals, if we look at gold, I haven't marked it yet, but it made new all-time highs on the 21st and settled back. This was just an intraday, let's run the stops, and then let's come back down again, right? So that's gold. I think it's going to stay up here for a while and then possibly make new all-time highs again, all right, with gold. Silver, same thing. You can see silver, and I got to adjust these, made new highs for 2024. I think it's settled back down, running stops, which is what gold and silver love to do. They'll settle in and they're going to make some new highs. If we take a look at energy, look at oil, small down day on Friday, but again, new highs. I'm going to need to reset these, but we're up. I like oil here. I like oil stocks. I don't think it's going to go much higher than this, but I do like it to maintain up at these levels. Okay, and then nat gas came down just a little bit on Friday, but I like nat gas down here to the upside. And we'll review a good way to trade these things using options in the futures market. All right, everybody, that's kind of where we're sitting right now. Members, I'll see you this Sunday evening for our weekly market watch. If you're not a member, I highly encourage you to come in. Be another good year for us. All right, everybody, take care.